The second quarter FNB BER Consumer Confidence Index rebounded from -6 to +4 index points. Sizwe Nxedlana, did I get it right there?
It's okay.
It's okay for a. I should do better coming from where I come from, but he's the chief economist at FNB. He's with us in studio. It really is a serious rebound, and if we go back this time last year, we came from a +1, -8, -6, +4. That's quite clearly an improvement.
Yeah, so I think there may have been somewhat of an overreaction to the bearishness that was implied on the household consumption expenditure growth relative to what's actually been delivered. So if you have consumer confidence levels at, say, -6 or -8, it's normally consistent with negative growth in household consumption expenditure. And while we've had a significant moderation in overall growth in household consumption expenditure from about 5 in 2011, we're sitting now at closer to 2, in fact just below 2. I think there was an overreaction relative to what's actually been
in that 6-month period. So it was from around September to September to March.
Yeah, so you've had Q3 up until Q1, where we've had deeply negative consumer confidence, consistent with a much more negative outcome in household consumption expenditure growth, which actually hasn't been delivered.
It's real strange, because if you were to ask most people today, the news that's been hitting them has been pretty bad. We've had the platinum strike that we are told is hurting the economy. Now we've got the NUMSA strike, which we are told could be 3 times worse if it continues for as long, because it's affecting 3 times more people. And yet the consumer confidence is going the other way.
Yeah, so I mean, relative to the NUMSA strike, I think that would be something that we would see in the 3Q outcome. And it would be relative to how long the strike takes.
But this would include the platinum strike,
so on.
surely.
It does include the platinum strike. But I mean, let's just think through that for a minute. If you look at the detail of the consumer confidence index, a large chunk of the improvement is actually a function of very resilient reported own finances, right? So consumers are telling us that they are still relatively not optimistic about the outlook for the economy relative to long-term averages. They don't think now is a good time to make big financial commitments, but their own finances they are very positive about. And if you separate that by or divide that by the various income bands, you actually find that it's a high income story. So high income consumer confidence is positive. I think it's +7. Low income consumer confidence is -4. High income reported own finances are sitting at +25, which is significantly above even the long-term average since '94, whereas reported own financial expectations for low-income households are closer to 0. And I think it also ties in with what we're seeing in terms of the JSE at record highs, steady increase in house prices. And also, if you look at this, the split of growth in disposable income, what you're finding is that the SARB is telling us that nominal growth in investment income grew 17% year on year, which is about 15% of total nominal disposable income, relative to a growth of 9% in
this
nominal.
This is really interesting if you overlay it what David Shapiro was saying a bit earlier. Many people in the high income brackets would have pension funds, retirement funds, perhaps the index trackers, a few shares. This is all related, the wealth that's growing there is all related to what's happening outside of the country, the dollar denominated. David says 60% of the JSE top 40 earns its money outside South Africa. So while that lifts, the people who are invested there will be doing pretty well. But if you go down the scale and you don't have a share of that, and you just have to make do with the difficult times that we're having in this domestic economy, maybe you won't be feeling so good. So it's all pretty consistent.
It is consistent, but I'd also say, I would argue the wealth effect is half the story. I think if you are skilled, educated, and are employed in the non-cyclical sectors of the economy, right? So in finance, real estate, and so on, and not low-skilled, employed in a cyclical sector of the economy like mining and manufacturing, you are doing relatively better. And in fact, it ties in with some work that we've done internally, where we were challenged to sort of get our heads around debt to disposable income ratios by the different income bands and net cash flows. And what we found using our internal data on our transactional base and also SA Inc. data is that debt to income is very high amongst low-income earners, and it declines steadily as income rises. And what we also find is that net cash flows, in other words, your earnings minus your essential expenditure, so what gets left after you've spent on essential items. Net cash flows are very positive the higher up the income bands you go, and very low at the lower income.
Again,
levels.
that makes sense because the banks have not been lending. The banks have been holding back. They don't lend. During the boom times, banks go crazy on giving people lots of money to buy houses. If you aren't lending, you've got to stay in the same house. You don't overextend yourself, and so on. It's a whole economics is very logical when you actually unpack it the way you have.
Yeah, I mean, I think so. It is a consistent story. So, and then I think the last interesting thing is if you split by race groups. What you actually find is that white consumer confidence is still negative, but it's been improving since bottoming, I think, in the second quarter of 2012. But there was a massive surge in black consumer confidence from -1 to +11.
Why?
I think it might have something to do with the election or the perceived positive outcome and the stability that the stable response to the election.
But why would white confidence be low? Because political stability is a fantastic thing for a growing economy.
Well, it's not low relative to where it's come from. It is low, but I mean it has been improving. And then the point I'm trying to make here is that, I mean, if you're talking about sort of the sustainability of consumer confidence, what we found was that black consumer confidence following the World Cup increased quite a lot, but that increase wasn't sustained. And so you might find that now that the election is past us and things are going back to normal, if I can call it that we might see that come off a little bit. But overall, for me, I think it's consistent with the theme of a significant moderation in household consumption expenditure, but without a collapse. So 60% of the economy, that's the household, still growing spending in real terms, but it's significantly lower growth rates.
So what is Jill Marcus likely to do after seeing these kind of numbers? Remember, we've had that first interest rate increase. Now we see consumer confidence is rising, which is saying that people are feeling a little bit more comfortable. Will she continue with ratcheting up interest rates?
I mean, I think so. I mean, we started as a theme, a macro theme for the year, calling the short-term cyclical outlook for the SA economy one of underperformance and adjustments. Adjusting from a position of a large current account deficit, expecting that current account deficit to narrow. We're expecting it to narrow because you, for the first time, have a weak rand when you have better global growth. So you should get an export response. And then expecting imports to also moderate because you've got this moderation, the slow puncture in domestic demand. What we've had is a partial adjustment. In other words, the adjustment is only coming from imports sort of starting to moderate a little bit because domestic demand is slowing, but without that adjustment also meeting halfway from the import, from the expenditure side, from the export side of the economy.
So it's getting better. We've been forced into it. It's almost like we were a little bit out of shape. We're starting to get more and more into shape now, and the consumers are saying, I can see that we're getting into shape, things are getting better. But
the implication for interest rates is that you still have a current account deficit that's not narrowing meaningfully quickly enough. It's narrowing, but very gradually, and sooner or later what's going to happen is that the cost of funding overseas as the Fed ends its taper and then the market begins to price in an actual increase in US interest rates followed by a rise in US bond yields, that if you still a South African economy with a current account deficit upwards of 4%, it's still going to become difficult to fund that deficit, which places pressure on the rand.
Rates have got to rise.
Rates, must rise.
Sizwe, thanks for unpacking all of that.